Welcome back, investors, to Ticker Time News. I'm Adam, and the stock market opened to wicked price action on the heels of the Consumer Price Index. The major indices bounced around their flat line after the CPI report showed continued disinflation in total CPI from 7.1% last month year over year to 6.5%, and core CPI from 6% year over year last month to 5.7% this month. Now, the key takeaway, however, is that services inflation, which the Fed has a keen eye on and is watching for improvement, did not improve. On a year-over-year basis, services inflation was up 7.5% versus 7.2% in November. Excluding rent from shelter, services inflation increased to 7.4% year over year versus 7.3% in November. And if you exclude medical care services, services inflation was up 8% year over year versus 7.6% in November. But those headline numbers, 6.5% for CPI and 5.7% for core CPI, were pleasing numbers for the market in general that had been trading with the belief that the Fed may be able to stop raising rates sooner than previously thought. Now, the higher services inflation point did not seem to hold back the stock market or bond market today, with price action in both markets indicating investors still believe the Fed will be able to pause its rate hikes sooner rather than later. In fact, the Fed funds futures market, which I'll pull it up here on the screen, now prices in a 66.4% probability of the target range for the Fed funds rate peaking at 4.75 to 5% in May versus only 42.3% probability just a week ago, according to the CME Fed Watch tool. Now, for the February meeting, which is our next FOMC meeting, January 31st and February the 1st, the probability went up to 93.2% from only 62.6% a week ago, of a 25 basis point increase again on February the 1st. And it is shown in this graph that 75 basis point rate hike has only got a 6.8% probability at this moment in time, and it has dropped significantly. Now, going back over here, let's look at the Treasury market first, and then we'll come back to the main indices. For the 2-year yield, which is most sensitive to changes in the Fed funds rate, initially spiked to 4.3% after the CPI report, before plunging to 4.11%, ultimately closing the session down 11 basis points to 4.13%. Mighty big wick on top of this candle today that's showing the volatility in the Treasury market. And if you see where it ended, right, let me pull this up a little bit and adjust it. We broke structure here, and the low we set back here, we broke that today, closing just slightly below that point. Is the 2-year going to go down even more? Well, that's up to the market to determine. It could very well. Right now in the after hours, it's basically flat. It's not moving. Now, the 10-year yield, let's pull that one up. It fell also 11 basis points today to 3.45%. Now, let me pull the 10-year up just a little higher. It broke that support that it had been holding for the past 3 sessions today, but it did not break the prior lows set over here back on December the 7th and December the 8th. So at least for the 10-year, it's holding up a little bit better than the 2-year because it didn't break that previous low. But it is still down 11 basis points. Yield inversion, yep, still there. It didn't go away, even though both dropped 11 basis points. Also, we do have to mention this. The St. Louis Fed president, because we had Fed speak today from a few different characters, but the St. Louis Fed president, Bullard, who's not an FOMC voter, so no vote doesn't count towards an increase or decrease or a hold in the rate hikes, but he's got some sway. Said that he thinks that the Fed should get rates above 5% as quickly as possible and hold them there. But again, market participants took that view in stride. The positive price action in the stock market was particularly notable considering the big moves leading up to the CPI report. Remember during yesterday's live stream, we talked about that big move at the end of the day? Yeah, that was considerable, wasn't it? Now, the S&P 500 was up 3.7% for the year entering today and is up 4.4% from its low of 3802 on January the 5th. Today, the S&P 500 spent a good portion of the session above its 200-day moving average at 3984, helped by some modest gains in the mega cap stocks before closing just a wicker or two shy of the key technical resistance. Now, let's dive into the charts and see why this rally, I don't think, can continue very much longer. Two things right above where we closed. There is the 200-day moving average, just like that. We also have the downtrending resistance line that has stopped every single major rally in 2022, and now it stopped it today in 2023. And if I adjust the chart right quick, just to show you the long-term trend line here, that we are still in a bear market, even though we are in a bear market rally, you can see that trend line. Every major peak on this thing has gotten a rejection when meeting it. And that holds true to this day. It did not and could not break above that today. Now, I hate this market. Yeah. A market that is not thinking straight. A market that has a lot of small cap companies bursting at the seams with a short squeeze right now does not help the market rationalize what has actually taken place. If we look, the IWM, which is your Russell 2000, your small caps, it was up 1.7% today. Compare that with the SPY being up 0.4%. A big difference. And it's because of all of the short squeeze action taking place in small caps. Now, that short squeeze, right? That lemon only holds so much juice before you got to grab another one. Same thing happens when you have a short squeeze in small caps. That lemon can only be squeezed for so long before the juice runs out, and then the short squeeze is over until the shorts reload on their short positions, meaning they need to grab another lemon to reset that short squeeze. So it's nearly complete in my opinion. And I think this market, it's reached its top for this bear market rally. Now let me go back in here a little bit tighter and talk about the reasons for why and show you the evidence on the chart to back up my theory for why I don't think this market can go much further. Okay. Now we talked about the two major trend lines above us, the declining 200-day moving average and the declining trend line that has stopped every major rally for over a year now. Think about that. For over a year, this trend line has held as resistance. That's pretty important. You can't deny that. All right, looking at today's candle also, it looks like it's almost a hammer candle. Okay, let me show you this right quick. So we've got several days here of a big run up, okay? And then we have this candle that's got a small body. It's got a large wick. I mean, a really large wick underneath it that actually came down and nearly tagged that 5-period moving average today. That is a big wick. And when we go look at the candlestick patterns, look right here. I'm sorry, I said hammer candle. I meant hanging man candle right here, where you have a run up and then you have a candle that's got a small body, right? And a large wick underneath of it. This is bearish. It is a topping pattern. And that looks like what we have going on the charts right now. We ran up, we've got a small body and a large wick underneath, meaning buyers were able to gobble up and push that body of the candle up, 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 but sellers remained at that resistance point. The 200-day moving average and the down sloping trend line both held the market back. Sellers stepped in to keep bears under wraps, okay? To cool them off. Great question. What is the reason for short squeeze today? The simple reason is that the market was too pessimistic. The market was overly bearish, and there were a lot of puts in the options market on small caps. Because in a bear market, what gets destroyed first? Companies that have no profit. And typically, that's your startup small cap company just barely making it onto the market. A good example could be an EV company, right? Investors or traders, they buy puts against a small cap company that's making no profit. And the expectation is the stock is going to go down, right? There are many examples of this. One I'm thinking about right quick, and I'll put it up on the screen. Rivian, RIVN, okay? Rivian, a small cap company, right, who hasn't made a profit, and the long-term trend for Rivian has been declining. Let me tighten this chart up, and you can see where it came from and where it is today. It has fallen. It had a nice period of consolidation, I'll give it that, on this chart. So it's not a perfect example, but it is one that in a bear market, what do you expect to happen to a fresh, brand new startup who's only been on the market for about a year now? You expect the stock price to drop significantly. So you pile in, you put puts against it, which is shorting the company. You think the stock price, the value is going to go down, and you just keep piling in. You keep piling, you pile in more, you get even more shorts on it. And eventually you get to a tipping point where there are so many puts against the company. There are so many shorts against the company. And I know I'm oversimplifying this, and I'm doing that on purpose, that there's a tipping point where, yeah, you know what? We've become over bearish, over pessimistic, and we've shorted this company way too much that the amount of float that's out there, which is the amount of stocks that are not held by a buyer or a seller, they're out there, and there is a short position against the company, and eventually you get to a tipping point where it tips way back into the favor of the bull, into the favor of, you know what, the stock price has got to go up because we've been too bearish. That's the simplest way that I could describe it. And if you look on Rivian here, we can go back here just a few days. The candles aren't huge. The moves aren't that big. There are other examples out there, but today Rivian was up let's call it 3%. The market was up 1/3%. Yesterday, Rivian was up 3.9%. The market was up, what was it, 1.25%, if that. The day before, it was down 1%. Go back a couple days, it was up 1%. So the short squeeze starts out and then boom, takes off. However, there's only so much juice, there's only so much fuel you can put in the tank before the shorts cover their position, causing the amount of shorts that are out there to decline, taking that imbalance back to a balanced state. And then the stock can proceed to go down and fall. Carnival Cruise Line, that's one that is doing good. CCL. And that's an example too. Let me put this up here right quick so we all know. That's one. Look at this thing. It's just been taken off. And it blasted right through that resistance point that I was talking about, that I said, you know what, we got to watch this point. If it closes above it, that's a good thing. But it's done that before. We just have to go back to mid-November where it had this shoot up right here, right? It's doing the same thing again. It was up 4.3% today. It was up, what was this? 1.9% yesterday, 2.2%, 3%, 2.8%, 2.4%, and nearly 10%. So that's what a short squeeze can look like. Now, Carnival did have some news come out, not a terribly crazy amount. Tilray didn't move. Let's pull that up. See, that's one thing that I want to make clear about when a short squeeze occurs. TLRY. Short squeezes can't last forever. It is a short-term process. Tilray didn't move. It was up 8.2% today. That's a pretty big move. Back to the short squeeze. It cannot last forever. Think about that lemon. When you squeeze it, only so much juice comes out. And then you got to grab another lemon. Same thing with the short squeeze. It only lasts for a short period of time, and then it's over. But shorts can reload, if you will, grab another lemon, and then there can be another short squeeze, a month, 2 months, 3 months, 6 months, whatever the case may be. It just depends on how many investors are bearish on a particular nonprofit company. I lost my train of thought there. Oh my goodness, I can't stand it when that happens. Okay, the short squeeze. The lemon dries out. You grab another one. Shorts have to reload, just like grabbing that other lemon in order to squeeze it. So that short squeeze, short period of time, but it can happen again and again and again, a month, 2 months, 6 months, whatever the case may be. It depends on how many people pile in and short a particular company. And when there's too many, that's when that imbalance occurs. Okay. So Tilray, that was a big move, 8.2%. You compare that to 1/3% that the market moved today, and Tilray completely outperformed the market today. That was a really big move. Yeah, everyone was bearish. You need some people on the other side. That is true. That is absolutely true. Crypto companies and some small companies ran crazy today. Yes, they did. I saw a lot of companies up 10% and more today. And a lot of them are the momentum retail type of stocks that have, showed up on message boards and so forth. Those are the type of ones that saw some pretty big action, but not all of them, a lot of them. Okay, let's see here. Oh, wow. Okay. Dollar will be going down. Good for us in stocks. Yes, it is. But there's a catch-22 with the dollar. Let me pull this up. The dollar, ticker DXY. And I want to go to the weekly chart. This is important. Actually, I can stay on the daily chart because it's clearly visible. The dollar here, right? It's been declining. We can go back here. You can say the top was in September the 28th. It's been declining, right? However, recently it had started moving sideways, giving some people hope that, well, you know what, maybe the dollar can withstand and go back up. Nope, it didn't. The dollar broke down from this rectangle sideways moving pattern. It broke down, it consolidated for 2 days where it barely budged. It barely moved. And then today, it drops nearly 1%. And look at the low. The low was 102.1. And what did I say? 102.5 is my line in the sand for the dollar. If the dollar breaks below 102.5, and I don't mean a wick, I mean the dollar has to close under 102.5 for me to say, you know what, that's it. The dollar is completely done and over with. But there's one other line in the sand too. And it is this blue ascending line right here. Okay. I'm not very good at highlighting things. You can see that blue line there, right? Okay. What did the dollar do for the past, not counting today, the past 3 sessions? Monday, Tuesday, and Wednesday. It stayed above that ascending blue line. Then today, the dollar broke down below that blue line and came all the way down to 102, 102.1 to be precise. That was the absolute low of the day. And then it closed today at 102.24. Now, I don't know why it says that it closed at 102.24, but it's obviously not on my, oh, I see what I did. I see. My purple line, oh, okay. You know what? I made a mistake. Let me do this right quick. I got to take these 2 lines off. I made a mistake. It did close. All right, there. I got to remove that. I'm going to remove this one just to clear things up a bit. The blue line running horizontally right here is 102.5. So the dollar did close below my line in the sand, 102.5. It closed again at 102.24. So in my view, the dollar is done. That is a good sign for equities, for the SPY, because when the dollar goes down for the past year, the inverse correlation to the dollar and the SPY has been the dollar goes down, the SPY goes up. The dollar goes up, the SPY goes down. That's been the inverse correlation between the dollar and the SPY for over a year now. That connection can break. It can snap in two because it wasn't always that way. If we go back just a little bit here in time, just a little bit, I want to get it right here. When we go back to when the strength of the dollar really took off, the bottom here was May 2021. Prior to that, the correlation wasn't as strong. And I'll demonstrate that by placing the SPY, SPY, over top of the dollar. Okay? All right. The orange line is the SPY. And then down below, all the candles and trend lines and so forth are the dollar. Let me pull this up a little bit. I want to open it up just a little bit here and get this lined up for you, so it's a little easier to see. Okay, I'm going to pause right here. This will give you a really good indication. So all the way to the left of the screen, if you look at this portion right here, okay, the SPY and the dollar didn't have that inverse correlation, okay? The SPY and the dollar, they weren't really moving that much together. And then the dollar, it goes down, and this broke March of 2021, and the SPY went up. But then if we look at July 2021, on both of them, what did they both do? They both went up until May of 2022. Now, there was a lot of volatility in the SPY. You can see that right here from December 2021 all the way to, this was what, April of 2022. So December of 21 to April of 22. A lot of volatility there. But overall, the SPY went down while the dollar was going up. And then since April, there has been this inverse correlation that has been very, very strong, where if the dollar goes up or if the dollar goes down, the SPY goes up, right? If the dollar goes up, right, the SPY goes down. It went down. It went down, even though it did have some periods where it went up. And then we have April here. Let me get my highlighter back on. It turned off for some reason. We have April of 22 all the way to the high for the dollar, and that was a big decline for the SPY. Then the dollar started to cool off. The SPY rallied. And then the dollar went sideways to slightly down. Boom. The SPY goes down. Now the dollar goes down and the SPY goes up. It's starting to break that inverse correlation. I think it's starting to break. And that weak dollar isn't going to necessarily mean a strong SPY, a strong S&P 500. Why? Because earnings will be the crux of the S&P 500 going forward. The dollar breaking down like this, I think it's done. I think that inverse correlation could also be done. Now, the second thing to point out is that with a weak dollar, and this is the catch-22, a weak dollar, guess what's been happening? Commodity prices have been going up. A weak dollar causes commodity prices to rise. And when commodity prices rise, what happens to inflation? Inflation goes up. So, if commodity prices continue increasing, look at oil. If oil continues to increase, then that could spell bad news for inflation, because one of two things will happen. Either inflation will go up or inflation will be sticky and it will not go down nearly as easily as it has from June until this moment in time. So that's the catch-22 with a weak dollar. And the correlation or inverse correlation breaking. That's what I could see happening here. What's your favorite EMA? It would be the 5-day EMA. And the reason the 5-day EMA is my favorite moving average is because it's the most frequently tagged moving average. And by watching the 5-day EMA, you can help yourself avoid FOMO. The reason why is you think of the 5-period moving average as an electrical current. I know you guys have heard me say this a bazillion times by now. Think of it as a light switch and a light in your house. When that light switch is on, current is flowing through, everything is good. When the candlesticks are touching the 5-day moving average, everything is all good. But when that light switch is turned off, the electricity cannot flow through. It gets blocked. When the candlestick becomes disconnected from the 5-period moving average, you know one of two things is happening. Either FOMO or extreme selling. It's either moving to an extreme degree up or down. And it usually will stay disconnected for 2 or 3 days before reconnecting with that 5-day EMA. And that can help you avoid situations where the market, that pendulum is swinging way too far to one side or the other. It's going too high too fast, or it's falling too fast. And it can help you avoid getting stuck at the top or at the bottom. It tells you, pause. Let's not worry about this one. We missed the breakout. That's okay, either up or down. Let's wait for it to come back in contact and we can go from there. So that's why, to me, it's the most important. And then your 20, 50, and 200. Those kind of go together as a group of moving averages, because with the 200, nothing good ever happens under the 200-day moving average. And with the 50-day moving average, it's bullish above, bearish below. And then the 20-day moving average is kind of similar to the 5-day EMA in the sense that it's showing you the short-term trend, if you will. Okay, so yeah, 5-period moving average by far. Loving BABA right now. Yeah, that's one that's been doing good because of twofold. One, it's had some deals with the government and the China reopening. It's also been a short squeeze candidate by far. It's been a short squeeze candidate. It did pull back 1.6% today. And here's the perfect example of that 5-day moving average. If you look, this thing was on the extreme, right? It last was connected to its 5-period moving average right here, all the way back on January the 3rd, the first trading day of January, the first trading day of 2023. And then it's been disconnected for 1, 2, 3, 4, 5, 6. Today, it finally reconnects. Because if you look at it, since being disconnected for 1, 2, 3, the 4th day, this thing really just started moving sideways in a new, like maybe trading channel. Who knows? I mean, it's come awfully far. It's fallen awfully far. And this rally, it gets back some of it, but not a whole bunch. So, another reason right here to demonstrate, we've got this thing taking off. If you missed the breakout, don't worry about it. Wait for it to come back in line with that 5-period moving average and then go from there. So it definitely helps you from getting, stuck at the top of chasing this thing even higher. So yeah, BABA's been doing really well. New sub, awesome. Thanks for being here. I greatly appreciate you and everyone here. You guys and gals are awesome, and the questions are the best part of this live stream. I love doing that, and it's the whole point of the live stream. Yeah, careful with BABA. Absolutely. It is pulling back. It has pulled back. Reconnecting there with that 5-period moving average. This thing since Monday, January the 9th, really has been moving sideways, right? So do be careful with that. I think the squeeze is over, if you will, for BABA before they reload, of course. All right. This one right here has been messing me up, if you will. Mullen, it's just, to me, it's not connected with reality with the moves that it's making. It definitely went on a short squeeze. We've got a bit of, a big wick on the bottom here. This is another example of using that 5-day EMA to make sure that you're not, chasing something that's about to come back down. If you look, it was connected here. Oops, I lost my highlighter. It was connected here with that 5-period moving average on January the 4th, and then it was disconnected for 1-2 days. The third day, right here, it reconnected, and then it was disconnected for 1 day, and then it reconnected. So using those helps you from chasing something that's about to pull back and allowing you not to get trapped at the top of a really tall wick. So use that 5-day EMA to your advantage to make sure you're getting in and out at good places and you're not chasing something that's about to end. That would be my thing. Does it have more room to go? I have no idea with this one, to be honest with you. I set a point where I said, you know what? It's got to break this level. And if I bring the chart a little closer together so those candles don't look so big, if you look, the wick of today, it wasn't too far off from this resistance line. So what could occur that it's broken out now is that this old resistance becomes new support for it to have maybe a new trading range up here, or the short squeeze is running out. It's always a possibility, right? But it's definitely one that's thrown me off. I never expected this thing to run up, 25% in a day, but then it dropped 10%. So you got to be careful with these for sure. I need a good retrace for Amazon. You will get it. You will get that retrace for Amazon. Amazon is laying off people. It laid off more people from its gaming division. You will get a retrace for Amazon. It's coming. So hold tight. You'll definitely get it. Now, if we look here at the Amazon chart, just right quick, I'm going to move it up here and blow it up a little bit. There is this resistance area that Amazon has found itself in. And you can see today it kind of maxed out there. It was up 0.2%. And this matches up here. We can find a match here, all through there, and also right there. So this is a resistance area for Amazon. Not sure if it can break higher on this. I think the pullback is coming. Yeah, it did get above its 50-day moving average, which gives you a bullish context. However, it is disconnected from that 5-day EMA. And whenever that happens, either it's going to start moving sideways so that 5-period moving average can come up to it, or it's going to pull back. So we've got both of those stories to contend with the Amazon price action here. But I think it's reached its limit. I think it's going to pull back here shortly, if not tomorrow. The big banks reporting tomorrow morning, that's going to give market participants a huge, huge outlook on the consumer. Are there big credit card delinquencies? Because we know that credit card spending has shot up dramatically, right? Billions and billions of dollars in extra credit card spending has occurred over this holiday shopping season. And we know that the savings rate right now is practically zero. So what are credit card delinquencies looking like at the big banks right now? That will give us a clear sign tomorrow. And potentially, if that's negative, a retail store like Amazon, you'll get your pullback. And I do believe that no matter what, you'll get your pullback. It went too far with this 5.8% move here and being disconnected from that 5-period moving average. So you'll get it. Is SPY still sideways? Let's look. Let's go to the SPY and let's dig into this thing. A couple things to point out about the SPY. Number one, I needed to extend my trend line here a little bit further. Okay, this is the 2022 super trend line, right? That has stopped every major rally in 22. Well, the SPY, unlike ticker SPX, which also tracks the S&P 500, that just has higher liquidity. The SPY didn't get up to this declining trend line. So this is the first area to say, all right, hold up, wait, we might not be able to get past that. The 200 period average, 200 moving average is also right there. And that did stop the SPY from going any further. So we've got those two trends that are not in favor of this rally continuing. And then if we look a little bit closer, and then we'll also dive into a shorter time period. If we go a little bit closer here, we can see that even though it gapped up yesterday and became disconnected from its 5-period moving average, it practically came back down and reconnected with it today. It's got a long wick underneath it with a really small body. Now, when we have an inclining equity, and then we get a candle that's got a flat body and a long candle underneath of it, let's look at the candlestick chart once again. And this is a hanging man type pattern where we have the run up. Oops, don't want to do that. Where we have the run up. Why is it not working? There we go. We have the run up. We have the small body and we have a long wick underneath. This is called a hanging man pattern. It is typically bearish and a sign of a reversal. Okay, so that's what the setup to me looks like. All right, let's go into a closer time frame here. Let's go to the 15-minute time frame because there is one particular sign that says, at least right now in this moment, bulls are in control. Okay, and I'm gonna close off a couple of trend lines here because the time frame has changed. And I want to put the 5-period on here. Okay, let's bring it down. All right, the one thing that I would say is bullish in this context on the 15-minute time frame. Now, we've got a few days here. All right, number one is the bottom here. It was met right here. And this was on January 10th. And this was right around the 865 a share. Then we had a nice steady rally, and I can do this. I can throw this trend line right quick right here. Let's put this trend line up. Let's get it lined up. Get the right points connecting. Okay. All right. When I put this trend line up, what happens? Well, it looks like the trend held. When we look at today's pullback, right, it held above this trend line in the last, what, maybe hour of the day. That was good. That's a positive sign. Also, the 5-day moving average is inclining. When you have a 5-day moving average that's inclining, that should give you a bullish to positive bias on the very short term. We're looking at the 15-minute time frame. The second, or I guess that was the second, the third thing is if we were to clone the trend line, and I probably should have done this one as the second. If we clone this trend line and we move it up top, does it match? Look at that. It connects at the start right here. It connects here. It connects right here. And it almost tapped it right here with the wick. It came close, but it didn't. This is a nice trending channel, a nice ascending channel for trading in. So there's 3 things that are positive for the SPY in the short term. But then you have your longer term picture, which is it's disconnected from its 5-day EMA and it needs to reconnect with that. It is right under its 200-day moving average, which is a significant resistance point, and it is underneath that declining trend line that has stopped every major rally in 2022, and it looks like it's going to stop it in 2023. I mean, that trend line is literally right there. We're really close to it. So there's some short-term analysis on the SPY that gives you at least some positive things to look at in the short term, and then some bigger term things or longer term things that are negative for the SPY. But what's going to determine whether the SPY can continue in this channel are the bank earnings tomorrow. For the past year, technical analysis has been great, but headlines have been driving the narrative around the market's movement. So whenever a piece of economic data would come out, or a piece of earnings from this company, that sector, or wherever was negative, or even positive in some cases, the market would react to that headline, not necessarily to the fundamentals, which in a bull market, we're typically more fundamental based. In a bear market, we kind of become detached from the fundamentals and we become more technical and we become more fragile, where we overreact to headline news. Okay. So just 3 different things to consider when looking at the SPY. So I guess my long-winded answer there about the SPY boils down to, on the short term, there are some positives for the SPY. Bigger term time frames, it's getting really close to resistance, and it is most likely going to pull back from here, okay? Even though we do have these shorter term kind of positives. But if it broke that support even tomorrow morning, then that channel is done. It came out. Of course, you can have a false breakdown, so you need confirmation to make sure that it is factual. But that breakdown, and if you get a back test up to it and it fails, it's not false. It is true at that point. So a couple things to consider there for you. I do believe the SPY, the S&P 500, they are about to pull back. Whether that's because of the bank news from earnings tomorrow morning or something that occurs next week. Because tomorrow morning kicks off earnings season. And earnings season will be the trump card for the entire market over the next several weeks, over the next month. And we'll get a good read on that tomorrow morning. So stay tuned for that one. I just want 5 good stocks. It's too many out there to keep up with. You know, that is a true statement. That's why most people, they get maybe to 30 stocks and that's it. And that's their diversified portfolio, right? Having 5 good ones, that would be wonderful. In this day and age, in this market, with what we have in front of us, you want to make sure that you're looking for stocks that are positive, that are cash flow positive, that they're obviously, if they're cash flow positive, they've got profit. You want to see a good, clean balance sheet. You want really strong companies, right? Really strong. The ones that have led us over the past decade, you got your FANG stocks, right? They've been getting crushed. Are they near bottoms? Some of them. Some of them, like Apple, I don't think it's close to its bottom yet. I think Apple's got a ways to go before it gets there. And Apple is such a big mega cap company that it can drive the S&P 500 real easily. So right now, trying to pick 5 stocks is very difficult, if not near impossible. In this type of market, this is a trader's market for the most part. When things get too wacky, like things were this morning, it's not that best market for anybody. I guess that's what I would say in short. Let's see here. Hand purple blue piece. Okay. Awesome. What is smart money indicator on your TradingView? A smart money indicator. All right. So what you'd want to look at is HY, the ticker symbol, HYG. Let that load to pull it up. This is the iShares box with an extra X, high yield corporate bond ETF. This is considered your quote smart money. The SPY is considered your dumb money. Okay. So if we're looking at HYG and we want to compare that to the SPY, let me turn on make sure I got these couple of indicators on. I'm going to overlay this with the SPY. Okay. Now, what you want to look for here are these types of patterns, divergences. If HYG, if that ticker is making a higher high and the SPY is making a higher high, everything is in confluence. It's moving together. But if HYG makes a lower high and the SPY makes a higher high, you have a divergence. And typically, HYG, the ticker, will lead the SPY. So it may be a day or two ahead of where the SPY is going. So if you look at HYG right now, going from yesterday up 0.6% or 0.7 to today up 0.6%, it slowed down a little bit. The day before that, though, it was flat. It was moving sideways. It has been disconnected 1, 2, Is that 2 or 3? I can't move this so I can see. It looks like it was disconnected 2 days. Day 3, it reconnected with its 5-day EMA. It's disconnected with it now, so this thing is liable to pull back relatively soon. It's also at resistance, right? So those are the two that you want to compare. Smart money versus, quote, dumb money. I have no idea why why they call it that. But let's look here at HYG while I've got it pulled up here, okay? Let me bring a little more price action in here so you can see this. All right, number one, you know, we're at resistance, right? Right there, right there. And if I go back, we had a little bit of support for a day there, a little bit of support right there, completely skipped it right there. And then we've got a little bit more. Oops, can't highlight it because that's in the way. Oh, come on, out of here. Okay, so we're at resistance. And then if I had that downsloping trend line that has stopped every rally in 2022, then it would be coming through just like this. And it would be coming through, you know, just like this, just like it is on the S&P 500 right now. So can it go further? It doesn't look like it can. It looks like it has run its rally course. It went fast and hard. It front ran a cooling in CPI, a cooling in inflation. And now that it has front run that cooling of inflation, well, now it can cool off itself with price action and pull back. So I'd expect a pullback tomorrow in these types of names all over tomorrow. But the one little asterisk that you have to pay attention to are bank earnings tomorrow, okay? Those are important. Is the 10 EMA more accurate? That's a good question, and it's debatable. I'll give it that. It is debatable. I don't particularly like the 10-period moving average. I like the 5-period moving average better than the 10. I think that one, to me, is a little more accurate when you're looking at overextensions, up or down. But some people do use the 10 over the 5. I think that's a personal preference. It's a debate on which one is better. Use the 10, see if you like it. Use the 5, see if you like it. One of them you will become more comfortable with, and you will become more confident with. So try both out and see which one fits for your trading or investing style. That's what I'll say about the 10 there. Okay, wonderful questions, guys. This is awesome. Okay, AAL and Netflix. So we've got American Airlines. American Airlines has been on a very significant run. And if I pull up my, hold on, I got to log in right quick. Let's see here. Let's go. AAL. All right. And we pull up options. So right now, the options market is pricing in a plus or minus, what is it? 62. Oh, that's one hard to make. A 62-cent move tomorrow, plus or minus 62-cent move tomorrow. Not really big. If we look, we are at a point right now where it is stretched to the upside, okay? Really stretched. It is really disconnected from that 5-day moving average. And, it's done a good job of staying connected with it. It is above its major moving averages, all three of them. But this is a huge move that I cannot imagine will hold, right? A lot of times when you get big, explosive rocket ship moves like this with a huge gap. I mean, look at this gap. I mean, it is huge. The next day, you give most of it back. That happens a lot. And with the options market pricing in just a 62-cent move, well, let's see. We're at, let's call it 1680. And if we drop here, we would go, 8 to 5 and 5 to 2, which would put us right back with the 5-day moving average. If we were to go down, that is, it would put us right back in contact with that 5-day moving average. A 62-cent move. And again, that's up or down. There's no, it's definitely up or it's definitely down. The way the options market prices it in, it prices it in with a plus or minus move. And right now, it is a 62-cent move. And that is fluid. That number can fluctuate. It can change. Tomorrow morning, it may be different. Like the SPX, for example, which I use for tracking the S&P 500. Yesterday, it was calling for about an $8.50 move for Friday. Now, it's calling for, let's see, where is this? Oh, wow. It's moved quite a bit. Let's see. For the SPX, it's calling for a $33.49 move tomorrow. That is incredible. Absolutely incredible. And if I look at the SPY tomorrow has a $3.53 potential move tomorrow. Okay. Plus or minus. So we can do the calculations on that a little bit later. But for American Airlines, I think this was a big move. I don't know that this is sustainable, right? Because typically this thing moves. It's been in going back to June. It's basically just been moving sideways in a rectangular box. But it has fallen from a really high point. And with the travel news of late, right? How in the world do you expect this thing to go up, 10% in a day when we have all this negative travel news? Even if American Airlines isn't, wrapped up specifically, in this or that. It's just a little bit bonkers. But even going back here, if I, kind of leveled out the price a bit, and bring it a little more in focus, you can see that even though there's some moves within here, overall, we could really go back to March of 2020, and American Airlines has basically moved sideways. Okay. So I don't think American Airlines has a lot of juice left in its tank. It ran up fast and hard. And typically, if something runs up fast and hard, it can fall fast and hard. So that's that for American Airlines. All right, Netflix is in a different boat. Netflix is completely different. Let me open this up and go to Netflix. NFLX. Netflix was in our top 10 momentum stocks list for this week. It was also in our number 1 spot in our top 10 stocks list last week. And last week, Netflix did 7%. So that play worked out really, really well. This week, it's working out pretty good too. But let me point this out to you. I got to open it up so it's a little easier to see on the chart. Netflix, these two purple lines on the screen, these are the weekly expected move. They are a formula that the options market prices in the expected move over a week's period of time. Okay. So when we look at Netflix, the upper end of its weekly expected move was $331 a share. It closed today at $330 a share. $1 under its weekly expected move. So by the close of business of Friday, 68% of the time, an equity will close in between the two expected move numbers. So since Netflix today reached that upper end, and it's also got, look at this again, I think Netflix is just going to go sideways tomorrow, if not pull back some. It's connected with its 5-period moving average, which is a good thing, okay? But it has run up pretty quick, right when I need my highlighter. It has run up really quick, and then it has a candle with a small body and a long wick underneath of it. Pulling up the candlestick chart again, you're seeing this hangman chart pattern all over the place right now because stocks have run up, and today they made a small body, long wick underneath. That is a hanging man pattern, and it is typically a reversal pattern as well. Okay, so that's what we're looking at on a lot of stock charts. That's what we're seeing. The run up, and then today leaving the small body candle and a long wick underneath of it. Another thing to consider about Netflix is once they hit their weekly expected move, whether the top number or the bottom number, they typically hang around there. They will move sideways, right? Go a little above it, go a little below it. They'll kind of move sideways along that number. So it'll be interesting to see how Netflix reacts tomorrow to being at the upper end of the weekly expected move. Now, 68% of the time, it stays within those two numbers. But that's only 68% of the time. That means it can go outside, up here or even down below, go outside those numbers a smaller percentage of the time, okay? Knowing that helps you greatly when you're trading and knowing, okay, I should start taking profits here. Once it tagged that the upper end of the weekly expected move, if you bought in on, Monday or Tuesday or whatever, and you catch the run up, it reaches that weekly expected move, take a third of your profit off the table. Take 2/3 off. Leave the remaining third on the table to see if it can break it or not. A lot of times too, with the weekly expected move, if it breaks out, it typically will come and close the week right back in. So when it pulls out, you can take a short position when it gets up here, knowing that 68% of the time, it's going to pull back and close within those numbers. And then the same thing on the bottom side. If it pulls out and goes below it, you can take a long position here. 68% of the time, it's going to come right back up and close inside those two numbers. That's why the weekly expected move is such important numbers to know. We do weekly expected moves on about 40 different products. Just click the first link in the description. That'll take you right there, and you can get instant access to these numbers that we put out. There's an equation that you go through to come out with the number. It's based off of options, information, implied volatility, and a few other factors to get these numbers. We can also do it. We're working on a daily one, which gives you, all right, are things too frothy? Are they overextended to the upside, to the downside? What is it? And right now on that daily chart, so many of the products in the S&P 500 are screaming red. They are at their upper levels. And whenever we get those readings where they're just screaming red, it means the market is at or near its top. And we're about to get a pullback. So we can flush that out and balance the scales again. Okay? All right. So that's where I think we are on a lot of these. Hey, everyone. Let's all do... oh, yeah. Do the like button. Yep. Click the like button. Share the video with a friend. I greatly appreciate it. Hidden Gem, thank you so much. I appreciate that, Mel. That is wonderful. We need to help him get so he can help others learn. That's the whole point. I would rather you learn instead of me saying, oh, go this stock, go to that stock, go to this stock, buy this stock at this level, buy that stock at that level. I would rather help teach you to understand yourself how to get to, okay, this looks like a good stock. This looks like a good entry point. I want you to know how to do that. Do you give a man a fish to feed him for a day, or you teach him how to fish so he can eat every day? It boils down to that. And I would rather teach than to give. Maybe I'm saying that a little bit wrong. Give is probably the wrong word to use. I'd rather teach you to know yourself what to do. Put yourself in the driver's seat so you know what to do. That would be much better. Much, much better to me. Oh, thank you. I greatly appreciate that. Absolutely. You're awesome too. You are totally awesome. I mean it. I use the 9-day EMA intraday on the 1 and 5 minute time frame. That works. You know, when it comes down to these moving averages, outside of the three main important ones, the 20, the 50, and the 200, when you're getting down to the nitty gritty of a 5-day, a 10-day, whatever the case may be, whatever works for your trading strategy, that's the one you need to use. And you may need to use a little trial and error to figure out, is it a 5-day EMA, a 10-day EMA, a 9-day EMA, and the time frame that they work on. For me, I love the 5-day. It works for my style. That doesn't mean it may work for your style. That's why you need to test out these smaller moving averages with your trading strategy. It works great. Immediately adds AAL to short watch list. Oh, wow. Yeah, man, if it comes and it keeps screaming higher, I'm going to be upset at myself. I'm going to put it down here so I can double check it tomorrow at the close to see how it does tomorrow. Man, oh man. Me, oh my. Okay. Wow on American Airlines. Absolutely. LOL. Let's see here. Tomorrow move will be relatively slow to 400 or a huge move down. Gamma exposure encouraging high liquidity by MMs. Likely a low volatility day, hence the decrease in expected move prior to today's open. Absolutely true. Absolutely true. That pullback, it's coming. It is definitely coming. If we look at the SPY, and let me open this up again so I can get the exact number. Got to do my password every time. Give me just a quick second, and I am in. All right, going to the SPY. And right now, I mean, the SPY is at a $3.53 move. Plus or minus, up or down. So what are we looking at? What was that again? 353. So, please excuse my drawing here. $3. Got a little dot there. And what did I say? 53. Ooh, looks more like an S than a 5. That's a 5 right there. For those keeping score, that's a 5. And then I need another 3. So that's what we're looking at. All right. Plus or minus right there. A $3.53 move on the SPY. So it closes at 396. Call it 397. All right. 7, 8, 9, 10. That's $400 a share. Where is $400 a share? Well, I'm going to put a horizontal line on the screen. I'm going to make it a dotted line. Give me a quick second. I'm going to put it right on 400. It's at 4. Actually, I should leave it at 450 because it's a $3.53 move. So this dotted red line right here, that is a $3.50 move above where the SPY closed. So according to the options market, that's how high the SPY could go tomorrow. And where does that put the SPY? Look at this. It puts it right on the down sloping trend line right here that has stopped every major rally, every rally that has gotten to that level in 2022 and now in 2023. That's just incredible. Now, on the downside, if we're looking, take $3 away from, where did I say, 97. So that would take us down to 94. And I'll put another line there, horizontal. Let me change the number. I want 394.5. So according to the options market for tomorrow, that's what the options market is pricing in. And the options market is right 68% of the time with these numbers. Cool. Cool. Now, that's not to say that it's either going to go up to 400 or down to 394. It can go further than that. Now, I think the upside is limited due to the downsloping trend line. So 400, I really think that's max. 400, 450. 450 cents. I think that's the max. But the downside, I don't think is limited like the upside is. Right now, I think on the SPY, the risk reward is skewed to the downside. We have a limit to how far we can go up. but we could break that 394, come back down to the 5-day EMA and close down there. One other thing to point out, we've got the weekly expected move that we need to talk about. The weekly expected move on the upside for the SPY is right here at 397. And we literally closed, what, 4 cents from that. 4 cents, 4 pennies underneath the upper end of the weekly expected move. The lower end on the weekly expected move is all the way down here. I don't think we're going to get there, but that was at 378. And again, that's the options market pricing that potential move in for the week ahead. Meaning by the close of business on Friday, the SPY should be in between those two lines, and it's right 68% of the time. So I think we're looking good. Your call, I think, is spot on. Spot on. Absolutely correct. I do. Great job. Great job there. Netflix is still expensive. Yes, Netflix is still very expensive. All right, let me go down to the Qs and also put this expected move in, so we know where the QQQ might be going tomorrow as well. Let's put it in QQQ. All right, let's go to options and boom, a $3.12 move for the Qs. Let's do that. We'll come up here. So I need a 3 again. So we got our $3. The decimal point is not that great there. And 12. Okay. So let's see if I can do. All right, that's good enough for a 2. All right, and again, this is plus or minus. Okay. So it can go up or down by that amount. That's what we're looking at for the Qs. A plus or minus $3.12 move tomorrow. So where does that take us? We closed at 279, 80, 81, 82. Okay. So let's do that. Those dotted lines again. And then during tomorrow's live stream, we'll see how this all worked out. Okay. What did I say? 82. Well, I can just drop this anywhere and then plug it in. Okay. 282. I'm not going to worry about that 12 cents right now. So the line's not going to be perfect. That's where it takes us on the upside. The potential downside from where we are, let's get the line in. So where we're at, we closed at 79. We take 3 away. We're at 276. And again, I'm not going to worry about that 12 cent at this moment in time. So the options market is saying, okay, tomorrow, this is where at this moment in time, and again, these numbers are fluid. They do change. The QQQs could move $3.12 up or down, and these red dashed lines are giving us that visual of where it's at, where it could go. And unfortunately for the Qs, we have that same pattern that we've been seeing literally everywhere. We have this strong move higher, followed by a candle with a small body and a long wick underneath, okay? Back to the candlestick chart one more time. This is a hanging man pattern, right? We have the run up. Oh, I don't want to move the chart. Now it's drawing a line for me. Okay, can we do this? Oh, well, okay. We run up, right? And then we have a small body with a long wick, hanging man pattern. It is bearish, okay? And it's a reversal pattern where we pull back. That's the pattern that is on so many charts right now, including the QQQ. And we're seeing it on a lot of charts. It's on the SPY, the QQQ, the SPX. We've seen it everywhere. Everywhere. Are any of you in the Twitch chat as well? I have no idea who's in Twitch or YouTube. I know Twitch is I know right now I'm streaming to YouTube, Twitch, and Twitter. So all three of those do have a feed going to them on our channel, our channels, Ticker Time News. So big drop in the VIX today to 1883. Okay. I'll pull up the VIX for you. Why were these tickers added? Did I click something wrong? I got American Airlines and Bed Bath & Beyond mysteriously on my my watch list here. I don't know how I did that. Must have clicked the weird button. Okay, let's go to the VIX, VIX, and I always choose the CBOE, which on TradingView is the second one down right here. Big drop. Big drop. 18.83. So you are absolutely correct, sir. I had, or ma'am, I had no IFR, sorry, IFR fund. Let me get that right. IFR fund, you're absolutely correct. Let's see here. Look at this. Wow. Okay. I mean, we've got a perfect trend line right there with these. Oh my gosh, this thing looks like it was. I'm actually going to throw the trend lines up here, not just the Sharpie. Look at that. And then even on the bottom, it's almost connected. So we've got an expanding channel there. But look at those candles. They look like they were perfectly positioned. That is just crazy. But yeah, big drop today. That doesn't mean volatility is out the window. But it does mean volatility should cool down. And this right here is exactly why. When I look, let me put it back up again here. Give me just a quick second. I gotta log back in every time the tablet goes quiet. I've got to log back in, and we're there. For the SPY, again, a $3.53 move up or down, plus or minus tomorrow. At this time yesterday, that was an $8.50 move. So it went from $8.50 down to $3.53 in 24 hours due to volatility coming down. So that expected move based on the options market tomorrow, for tomorrow, has come down. The expected move has come down. It's dropped significantly. It's dropped a whole $5 for the SPY. It's just incredible. And it's because of this drop right here, 10.72% drop in the VIX today. I'd expect this to cool off a little bit tomorrow. All right. And then I'm gonna let's see here. Oh, IFR. Got it. Understand. Oh, that is cool. Instrument flight rules for pilots in bad weather. Oh, that is awesome. That is awesome. Oh, and Junkmaster, you're in school for Ospreys? Awesome. That is totally cool. I am so glad you guys were sharing that. That is awesome. That is awesome. Absolutely. So Twitch doesn't allow subs. That's weird. And I'd be clueless on Twitch too. I have no idea. Man, I have no idea what even to even think about. Mr. KZ Demos, he suggested to set up the Twitch stream, so I did, but I have no idea what in the world I'm doing. I use a live stream software so I can go out on YouTube, Twitch, and Twitter at the same time. So I don't even look at the Twitch page. I do look at the YouTube page because that's the primary source. But man, anybody know anything about how Twitch works? Put it in the comments. I haven't got a clue. I guess I should probably learn it, huh? Okay, right quick before we wrap things up. This has been such a great live stream. You guys are totally awesome. Totally awesome. I greatly appreciate everything that you guys do and all the questions, comments, everything. It's just wonderful. All right, the biggest bit of economic data tomorrow, outside of the bank earnings, of course, is the Michigan Consumer Sentiment, and this is the preliminary reading. The forecast is a 60.5. The prior reading was a 59.7, okay? Right over here, prior reading and the forecast. So it's forecasted, and this is a preliminary, not the final reading, to go up a little bit. And if we actually pull up the chart, which is really cool that you can do this in TradingView. Oh, that's awesome. Was just trying to promote the channel. The stocks and bonds category is dry. Your knowledge would be would gather followers fairly quickly. Oh, that would be cool. That'd be real cool. Paid subs come later. Okay. So I guess I need a certain amount of followers. I have no idea how Twitch works, but that's good to know. That's really good to know. I'll look more into Twitch and see if I can't figure out what's going on. Anyways, back to the Michigan Consumer Sentiment Survey. You can see it reached its low point back in June, and it's been rising, 59.7, the prior reading, and we're looking for a 60.5 tomorrow, which would have this line tick up a little bit higher, which is a good sign, right? If that confidence starts to come back in the survey, that would be a boost for the market, and that would help us to obviously get to 400 on the SPY tomorrow. But the big banks are going to be a big driver tomorrow. All right, let's close that one down. Don't need that up anymore. And we'll go back here. Okay, any other questions? I think I've reached the end of my notes here. I think I've gone through all the questions you guys have had. If you have any others, let me know. I'll give you a few more minutes. Click that like button, share the video with a friend. Those two things, honestly, they help out greatly to help grow this channel and get education out there for a lot of investors who are searching for it, traders who are searching for it. So those two things greatly help. And if you like the perspective and you want more, click the first link in the description. It takes you to our Patreon page. You can just join up there if you want to support the channel, or you can get more knowledge. It's there. So I'll leave it at that. All right. Wonderful day today. Thank you, everyone. I greatly appreciate each and every one of you for being here, for asking your questions. I love it. I'll be back tomorrow after the market is closed to talk about what happened, why it happened, and to wrap up the week, hopefully in a nice little bow, with the year still being in the positive, not the negative. That would all be wonderful and nice. And we'll also talk about our top 10 momentum stocks list to see if it beat the market this week or if it underperformed. Last week, our top 10 stocks list beat the market by about 3%. So we were up 5.1%. The SPY was up 1.9%. So it was a good week last week to start off the year. Okay, let's see. Is this one you guys talking, or I don't know either. Oh, talking about Twitch. Okay, good. I don't know either, but given your day-to-day knowledge, Vice, the board or overview would add a new perspective. It's mostly intraday scalps and told you so. Oh yeah, I can't stand those. Yeah, I told you so. The stock was going to go up. Yeah, when you mentioned it 6 months ago, of course it went up. Your discussion is new. Thank you. I appreciate that. Absolutely. And I'll do some more digging and working on Twitch to figure out if I can do anything on my end to help grow it. I will. You are welcome. Thank you. With that said, we'll wrap it up for tonight. Have a wonderful day tomorrow. And again, click that like button, share the video with a friend. If you're new, click that subscribe button. Greatly appreciate that. And I'll be back tomorrow, talk about what happened, why it happened, and what to expect going forward. Thank you so very much, ladies and gentlemen, for being here with me tonight. I greatly appreciate it. And with that said, I'll see you in the next video.